Welcome to the Live Big podcast, where real estate expert Nick Paynes shows you that everyone can build wealth through real estate investing. Nick and his featured guests will give you the tools, resources, and expert information you need to leverage real estate into a wealth-building strategy, so you can stop worrying about your 9-to-5 and start to live big. Here's Nick with today's episode.
All right. Welcome back, everybody, to another episode of the Live Big podcast. I'm your host, Nick Paynes, and today we're going to talk a little bit more about the syndication model of real estate. So we talked about some tax basics in the last couple of episodes, and before that, we talked some more about syndication and did our introductory podcast regarding syndication. So if you haven't caught up or if you haven't listened to those, probably best to listen to episodes. I believe it's episodes 20, I think it's 19 and 20, or it's one of those. But anyway, we talk about the basics of syndication, kind of crowdfunding for real estate. And on this episode, we'll continue to talk a little bit more about syndication, more specifically, kind of the fun part, which is how people get paid. So kind of without further ado, we'll kind of get right into it and just really talk about the best ways to create these syndication models and what you'll generally see when you're looking into syndications. And so going back to one of the prior episodes, we talk a little bit about the structure of syndication, which is generally that you have a general partner side and a limited partner side. So your general partners are generally the ones that are running the deal. They source the deal, they raise the money, they usually underwrite the deal, put together the property reports, they do the due diligence of the property, they're finding the property managers, they're going through everything to make sure that the deal gets done. And the limited partners are really just the financial piece of the transaction. So when we're doing the capital raise, if we're buying a $20 million building and we need to raise $6 million, the limited partners are going to generally be the majority of that $6 million raise. And they are limited partners, considered limited partners because they're limited in essentially their voting abilities on the property, which is essentially none. So they don't really get to have a say in what happens to the property. They just get to either put their money in or not. So when they review the property packet, when they review the strategic game plan that the general partners have in place, they get to determine whether or not they trust those general partners and whether or not they want to invest with them. So if they don't want to invest with them, then they just don't put their money in. It's pretty simple. So the big piece of the syndication regarding the limited partners is going to be the money, and then the general partners is the action essentially that's being done. So the general partners are the ones again that are out searching for the property. Okay, so it could be through brokerage relationships that they have. It could be maybe they have a relationship with a real estate attorney or an estate attorney, somebody who is constantly coming across deals where maybe somebody passes away in an estate and gives the opportunity to acquire a big piece of property. So it could be estate acquisition, brokerage relationships with other syndicators that may be getting out of one side of the transaction, all kinds of different things. So there's a significant amount of inherent value in the ability to source a deal. And so the first of all, that general partners get paid, there's generally five ways that general partner gets paid. And the first payment that they receive is what's called an acquisition fee. Now, generally speaking, in a syndication deal, a lot of the times the syndicators are usually well enough versed in real estate that they move into the transaction without the representation of a real estate broker. Okay, there will be a real estate attorney involved. There's usually an SEC attorney involved. Obviously, there's the banker, there's the insurance people. There's a lot of professionals that are looking in at the deal that's being done. But a lot of times it does not involve a real estate broker, especially because a real estate attorney is going to get involved in the process. And so what happens is because we don't have a broker fee, maybe a buyer's agent fee, what happens is the general partners will generally take an acquisition fee. And there's a couple things that are involved in that acquisition fee. One is the fact that it takes a lot of time and effort to source these deals. And the second thing is that it takes a lot of time and effort to get through the deal once they source it and get it under contract. There's a tremendous amount of due diligence that has to be done that I believe we've spoken about in the prior episodes, but things like walking through the property. If it's a 200-unit apartment building, you need to go to the building and you actually need to inspect each unit individually, okay? Because there are big things that could be happening in an individual unit that could really blow up the deal. So if you don't do your due diligence, you could be coming to your investors with some really pretty negative information down the road. So making sure you walk each unit in the property, an example of why you would do that would be, you get somebody that's doing drugs in one of the apartment buildings, and not just like smoking marijuana or something like that, more like meth. If we've got meth contamination in one of the units, there's a good chance that it's going to affect more than just that unit. And anytime we have meth remediation, it's literally down to the studs. We're removing everything from the property all the way down to the studs. So we could be talking significant remediation costs. So it's very important that the general partners go through and walk each individual unit. Okay. So there's obviously a large amount of time and money that goes into the inspection of the property. So not only are we hiring maybe kind of a general inspector or general contractor to go in and make sure all the major systems are functioning, but we're going in and individually inspecting each of these units for just, overall condition of the property, figuring out how much we're going to need when it comes to renovation of the property, right? So obviously there's a lot of time involved. To walk 200 units, you might be in each unit maybe 5 minutes, but to walk 10 units, you would need probably 2 full days. To walk 200 units, you probably need 2 full days to do that. So obviously you're going to have costs of travel to get down, to get to wherever the unit is. If it's not local to you, accommodation costs, a car, and then just your overall time. So there's a lot of time and effort and money that goes into the transaction before you even close. So that's just the physical inspection part of it. But now you also have the paperwork part. So you've got to go through each individual lease. Now, a lot of times what will happen is you can hire a property management company that will go through the due diligence. They'll basically inspect each individual lease that's written on the property and make sure that those individual leases line up with the financials that were given to you from the seller. So again, a big time constraint. And that's why commercial deals take a long time to close. They can take 45, 60, 90, 180. They can take longer than that to close, depending on the amount of due diligence that has to be performed. If we're going through 200, 300, 500, 1,000 leases, there's a lot of time and effort in that to make sure that it gets lined up with the financials that were given to us, or the pro formas that were given to us prior to going under contract. So there's a lot of work that goes in here, and that's where the acquisition fee comes from. So generally speaking, acquisition fees range somewhere from 3 to 5% of the total acquisition costs. And now, again, that can be a really big chunk of money, right? So if the property acquisition cost is 20 million, you're talking, 1% of 20 million is 200,000. So your acquisition fee may be somewhere between 600,000 to $1 million. Now, again, depending on how many partners there are working on the deal, and how they chop up that $1 million it's completely up to how the general partners do that. So, somebody might get 20% of it, somebody might get 15% of it. Depends how much they contributed to the overall acquisition of that property, right? So you may have a key principal, which we've talked about before. The key principal is someone that's signing on the loan for the property and holds the net worth value in excess of the loan amount to make sure that you can get approved for the deal. They may take a big chunk of it. So overall, that acquisition fee of 3 to 5% is going to get split up among the general partners, and that is something that the limited partners do not get paid upon. Okay. The second way that general partners get paid of the five ways is the asset management fee. So it's not uncommon to see an asset management fee over the entire ownership period of the property. So the property is owned for, let's say, 5 years. You might see an asset management fee of 1% on a monthly basis, or 1%. It's annualized, but it gets paid out on a monthly basis. So again, and this is generally based on the cash flow of the property. So if there's $100,000 per month in positive cash flow, for example, the asset management fee might be 1% of that, or $1,000 per month that goes to the general partners and is split amongst those general partners. Okay. The third thing is going to be cash flow. So overall, now the cash flow is going to be something that is split between the general partners and the limited partners. So like we talked about in one of the prior episodes, a common general partner or GP LP split would be like 30-70. So 30% goes to the general partners, 70% goes to the limited partners. So for example, let's say a property cash flow is $100,000 per year, or let's say $120,000 per year. That's $10,000 per month. That means 7,000 of it would get split up amongst the limited partners, and 3,000 per month would get split up amongst the general partners. Okay, so that's your cash flow, and that's one of the pieces that does go to both the limited partners and the general partners. Now, the limited partners get what's called a preferred return, generally speaking, and the preferred return is part of the cash flow. But what it means is that the preferred return, let's say it's 8%, it means the first 8% of returns goes to the limited partners. Okay, so it's almost like they're guaranteed the first 8% before the general partners get paid. Okay, so the investors are going to make their money first, and then the general partners get paid after that. So if there's a total of 8%, if their preferred return is 8%, and there's a total of an 8% return, on a monthly basis, for example, it is possible that the limited partners take the entirety of that cash flow, and the general partners don't take any of it. Okay, then the goal would be for the general partners to increase the cash flow to maybe say 10% the following year, so that they can start taking part in some of those cash flow gains. Okay, so that is kind of the third basic principle of return in a syndication, and again, both parties get to benefit from that. The fourth one for the general partners is the disposition fee. So the disposition fee is essentially the opposite of an acquisition fee. So upon disposition of the property or sale of the property, the disposition fee is, now it's a lot less than the acquisition fee. It's generally around 1%. Okay. But the disposition fee is going to be a fee that gets paid again to the general partners in order to prepare the documents for due diligence, prepare and pull financial reports, all the work that goes into selling the property. Now, on the sale of a commercial asset like this, we do use a broker. Okay, so a lot of times you're going to see a commercial broker that the syndicators will use to sell the property, so that they can be properly marketed on the commercial websites, the commercial MLSs like CoStar and LoopNet and things like that. Main one being CoStar. So, and also the brokerage relationships that those brokers have. So a lot of these commercial deals get done off market. They never even enter the MLS, and it's because these higher end syndicators generally have really good relationships with the commercial brokers that have kind of the inside track to get a hold of the right people to buy these deals. And when apartment complexes, especially, and when syndicated deals move from one syndicator to the next, a lot of times what you'll see is that the syndicator that did the first deal, they'll kind of in order to be able to sell the property and make it a little bit easier to sell, they'll kind of leave a little bit of meat on the bone, right? And so what I mean by that is, let's say you have a 100-unit apartment building. What they'll do is, if market rents are, let's say, $1,500 for all the units, When they go to sell the property, they may not have all the units at $1,500 per month. They may not wait until they get all the units at market rent. They may get it, let's say half of the units at $1,500 per month, and then maybe the other half of the units at $1,400 per month. And what that does is it allows for a pro forma return that says, hey, we're getting good returns on this property already, but there's still some meat left on the bone for the next investor to come in, raise rents, and make some money, right? So if they can come in, take 50 of those units, increase it by $100 per month, increase the cash flow by $5,000 per month and $60,000 per year, all of a sudden we leave some room for that forced appreciation that we've talked about before, that gives them the opportunity to add some value to the property, and they can make some money as well. So a lot of syndicators, like I said, when they're doing big value add projects, they may leave some meat on the bone when they actually go to sell the property. Okay. The next piece is, and the disposition fee again, is 1% generally. So if you bought the property for 20 million and got a $600,000 to $1 million acquisition fee, and let's say you sell the property for 25 million, the disposition fee might be 1% of that, or 250,000. Okay. The last piece is the equity. And the equity is just the difference between your overall spend, your acquisition price, plus any of your costs to rehab the facility, plus the new sale price minus all of the costs to acquire and rehab the property. So again, let's say you bought a property for 20 million. Let's say you put $1 million into it, and then you sold it for 25 million. Okay, in that case, you would minus all of your fees. To sell a $25 million property, your fees on the back end are going to be, call it 7%, and so you're going to have a nice chunk of almost $2 million in fees. So you may end up netting out maybe $2 million or so. So that $2 million is your equity gain, and that is again chopped between your general partners and your limited partners. Again, say at that 70-30 split. So general partners in this case on a $2 million gain, would split 400,000, and the limited partners would split 1.6 million amongst whoever did the raise. So that kind of gives you an example of the ways that the people who are involved in the deal get paid out. So again, general partners, 5 different ways: acquisition fee, asset management fee, cash flow, disposition fee, and overall equity return of the property. The limited partners are going to get preferred return, which is part of the cash flow, and equity. Now that preferred return, if the preferred return metric was, let's say, 8%, and over the entire hold of the property, you only return maybe 6% to your investors, then what's going to happen is on the sale of the property, when you have that equity sale and you do gain, have a nice gain at the end, the first 2% is going to go back to your limited partners first, because you need to fulfill that preferred return that was given to them in the original, property packet or whatever you presented to them when you brought them the investment opportunity. So anyway, that's how your that's how your payments work. Five different ways for your general partners, and generally two ways for your limited partners. So. Just a quick recap on how we're calculating returns on a syndication play. It is almost always done through forced appreciation and value add. So, every once in a while we get in a nice run up market and just overall cap rates compress. And so if a cap rate goes from 6% to 5%, we've got a nice increase in value, right? So if you've got, let's say you've got a net operating income of $1 million, and things are selling at a 5% cap rate, that might be a $20 million property. At a 6% cap rate, it's not going to quite be 20 million. It's going to be closer to right around 17 million, right? So those cap rates make a big difference in what your final sale price would be. So we may see cap rate compression and expansion, which may help or hurt the valuation of your property over time. But relatively speaking, markets tend to they don't tend to move that much when it comes to cap rates. Going from a 6 to a 5 is a pretty significant move. You might see 0.25% or 0.5%
would be a fairly sizable move. So anyway, what we're looking for as syndicators is we want to go through a value add or through a forced appreciation process, right? So again, we're looking for maybe a property that we would grade on a letter grade scale, maybe a property that we would grade like a C minus, but that's in like a B or a B plus area, right? So if that gives us the ability to increase the property's overall condition and appearance and make it, a B plus or an A minus property in a B plus area. That's really our best case scenario. So we're looking for properties that are low grade, but in higher grade areas, right? We might even find a C plus or a B minus area, but if we can find a D property that we can bring up to speed, we're okay with that too. What we don't want to do is we don't want to take a property that's a C in a C plus market and make it an A property, right? Because your renters aren't just, your A type renters aren't going to go into a C plus area to rent a really nice property, right? So we got to make sure that balances out. So we're looking for, again, the lower grade properties that we can value add in some of the better communities, the Bs, the B pluses, the A minus communities, right? Those value adds are going to come in the form of, rehabbing the property, whether it be exterior or just each individual unit. And so it could just be an overall updating of the property. But there's also a significant amount of value add that can come from essentially like amenity adds. And so some of the things that we can do from an amenity add standpoint would be adding like carports or garages, or if you've already got parking, adding some covered parking, right? So just putting up really like a kind of a lean-to roof shed that people can pull under that'll protect their cars from snow and hail and things like that. And, even if you're just charging $25, $30 per month, there's a significant value add there, right? So again, I think we've talked about this in a prior episode, but it people look at something that maybe like putting up a lean-to in a parking lot. Let's say it covers 20 spots, and let's say costs you $20,000 to put up that lean-to shed, and you're getting, let's say, $30 per parking spot, right? So you're getting $600 per month. So it's going to take you, almost a little over 3 years to make back that $20,000. But we can't look at it that way. In a commercial market where we're looking at cap rates based on net operating income, we can't really look at how long it's going to take us to make back our money. We have to look how it changes the valuation of the property. Okay, so again, if we have if we put up a carport that generates $600 per month in income, that $600 per month is $7,200 per year. So that $7,200 per year gets added into our net operating income, and if we apply the local cap rate to it, that's where we have a big difference in value change, right? So that $7,200 per year at a 5% cap rate is worth over $140,000 in value of the property. So are we going to put up a $20,000 carport if it increases our value of the property by $140,000? Absolutely, right? So obviously we have a law of diminishing returns, which is, if we put up carports everywhere across the entire property, you may have people that, or let's say you put up 3/4 of the property, people may not want to pay that extra $30. They'd rather just park outside. So now all of a sudden your carport spaces are sitting empty. People are sitting on the street because they don't want to pay the extra $30 a month. So then what do? You have to lower the price of the $30 a month down to $20 a month, down to $15, down to $10. So people start using the carports again. And now all of a sudden we don't have as good of a return. So when we're talking about amenities, a lot of times we want to make these amenities somewhat exclusive so that people find value in it, right? So maybe putting up some carports. Same thing could be said for garages. Obviously, garages are going to be more expensive to build, but they're going to be more expensive to the tenants as well. So instead of $30 for a carport, they may pay $100 or $150 a month to have a garage. That's not uncommon, at least here in our area. Some other value adds that can be put into place are things like storage lockers. A place could be a storage shed. It could be outside the unit, small rooms for people to store decorations or whatever it may be, because these apartment buildings generally don't have a whole lot of storage, right? Next one would be like Amazon lockers. These are becoming very popular as porch pirates, and people are stealing packages all the time that don't fit in the little, apartment mailboxes. There's a lot of places putting Amazon lockers. So you can rent an Amazon locker for $25 a month and have your deliveries put directly in a locked up kind of area for you to access later. So other things are like bark parks. Those are, if you've got a dog friendly apartment complex, you can put a bark park in. So it's something where the dogs can go and play. There's usually some shade, and there's some places for the owners to sit, and places for you to clean up after your pet, that type of stuff. But it gives kind of a nice outdoor space, and that can be something that can just give you an overall value add, usually to the whole community. It's not something that you're generally charging on a property by property basis. But what you can do is maybe get an extra $20 per month in rent overall per unit, just for having that nice amenity there. Okay. Other value adds could be washer and dryer either in unit. That can increase significantly, right? If you can hook up your in-unit washer and dryer, you might be able to get an extra $100 to $150 a month for a unit that has a washer and dryer. The other one would be if there's no washer and dryer on the facility at all, instead of doing in unit, find an area where you can put in a couple of coin operated, or not anymore, they're not coin operated. They're, operated by credit card or phone or whatever it may be. Attach your account to it and allow people to do laundry on site. So same thing. There's costs involved with putting that on, but there's also companies out there for big apartment buildings that you don't have to go buy a bunch of big washers and dryers. There's companies out there that they will come put the washer and dryer in there for you, and then they'll just take a portion of the profit. So it's like a win-win situation. They take some of the profit, and you get to enjoy some of the profit as well, but you're not paying any upfront cost to put washer and dryer in the facility, and you're not paying any maintenance costs, because generally they're going to continue to service the items. So if you have a washer or a dryer break, they're going to come out and take care of that for you. So some really nice, some really nice value adds there. So those are some of the ways that you can create value and again, create this kind of forced appreciation that we talk about. In addition to, having the market compress some cap rates, or just being in a very highly desirable area. So anyway, I think that's it for today's episode. Kind of a quick one today, just to go over the return basics of syndication. If syndication is something that interests you, it's definitely a little bit more of a complicated investment product from a real estate standpoint. But it doesn't have to be. And so getting some proper guidance on syndication, reading up and learning more on syndication. There's a ton of big syndication companies out there. There's a ton of small syndication companies out there. And each of them have access to unique opportunities and unique deals. So we at Black Yeti Group, we're always trying to source syndication deals. It could be apartment buildings. It could be multi-units, 10 plexes, 12 plexes, things like that. It could be big portfolio products where there's multiple units involved in a single portfolio. So there's all kinds of different ways that we look to put people's investments to use and get them great returns. So anyway, if you're interested in learning more about the syndication piece of real estate investing, please don't hesitate to reach out. Obviously, go to our website. You can learn a lot about syndication on our website, all our prior podcasts, and reach out to us at any time for a conversation and move you to your next investment opportunity. So anyway, thanks so much for listening. Make sure to check out our website and drop us a like or a comment, and keep enjoying this beautiful, at least here in Colorado, summer weather. It's staying cool here. Go out, do some fun things, and live big.
Thanks for joining us for this episode of the Live Big podcast. For even more real estate and investment resources, Go to blackyetigroup.com/resources and download Nick's complete guide to running your own rental properties. Tune back in next week for another episode, and until then, live big.
Live Big does not provide investment, legal, or tax advice, and nothing herein should be construed as being financial, legal, tax, or other advice. Live Big does not represent that any securities or services discussed are suitable for any investor. No investment or other decision should be made solely based on the contents or information found on the website or podcast. When making a decision about your investments, you should seek the advice of a professional financial advisor or qualified expert.